by our measure, the proposition in favor of apartments relative to single-family home ownership is at the lowest level of this century, meaning that apartments are more attractive than they have ever been relative to home ownership over the past 25 years or so. That is due to the fact that interest rates have increased, home prices remain high.
Hello and welcome to the REIT Report. I'm your host, Sarah Wilson-Keto. Today's episode was recorded on location at REIT Week 2026 in New York City, where my guest was Dave Bragg, CFO at Multifamily REIT UDR. Dave joined UDR in 2025, bringing over 2 decades of experience in real estate finance, investment strategy, and capital markets. So Dave, thanks so much for joining the podcast today.
Thank you for having us.
UDR recently announced it's switching to a monthly dividend, making it the first multifamily REIT to do so. What was behind that decision, and does it expand your reach to a broader set of investors?
Sure. So UDR has a focus on 3 strategic areas. One would be operational excellence, another is capital allocation, and the third is access to capital. So this shift to the monthly dividend fits under the third as we seek to find access to new and different sources of capital. In this specific case, we are making an appeal to retail and individual investors in the hopes that they appreciate what we have to offer, which is a 50-year history of about $9 billion of dividends paid, a healthy dividend yield today that has been characterized by stability and growth over time. So we're proud to be the first residential REIT to do so. That fits with our culture of innovation, and we look forward to spending time with investors of all stripes in the effort to explain what UDR has to offer to them.
Is there an education process in terms of getting the message out?
Yeah, we've done a number of things. We revised our investor relations website to provide information to that cohort of investors, in addition to the institutional investors that we meet here with at NAREIT. We've also upped our presence on social media and traditional media. So it's been a joy to spend some time with new forums to explain the UDR investment thesis and the total return track record, which is enhanced by the dividend yield.
And that must give you the chance to talk about REIT investing more broadly, I would imagine.
Absolutely. And REITs more broadly have a lot to offer. And that includes liquidity, it includes transparency, and it also includes no fees when one buys an individual stock. So we're very open-minded that those seeking access to real estate can learn more about REITs.
And do you think more REITs might follow your lead in terms of monthly dividends?
Oh, that remains to be seen. But we've learned a lot. We've studied this for 1 to 2 years, so we've learned a lot about it and really are committed to keeping a focus on it.
Great. And in other recent developments, we've had news of the planned Avalon Bay Equity Residential merger. Can you speak to UDR's perspective on that deal and really what it means for the sector?
Oh, absolutely. Our focus is on those 3 areas of value creation and what we can control. So going back to operations, we're proud that across shared markets, we have higher operating margins. That speaks to our focus on excellence, and we have the appropriate scale already to have achieved that. We are increasingly applying a data-driven approach to capital allocation. It's a very collaborative process that has informed our dispositions and our share buybacks, which have been a focus so far this year. And then we touched on access to capital as well.
So putting deals aside for the moment, what conditions are you seeing across the apartment market right now? And where does UDR fit into that picture?
Well, as I zoom out and I think about the big picture for apartments, you have some structural factors that are working in the industry's favor. First of all, demographics. People are getting married at a later age. They're having less children. That accrues to the benefit of apartment owners in that households desire apartment-style dwellings longer than they used to. In part due to that, we are seeing record low turnover. the share of residents that leave UDR communities each year is about 40%, down from above 50% a decade ago. And it's the sector lowest level of turnover. So we're very proud of the level of service and amenities that we provide to our residents operationally.
Yeah, that's quite a shift in those turnover rates.
Yes, it really has. And so that allows us to focus on the resident. And then in terms of pricing, rent increases vary widely across markets. The strongest markets at this time, of course, are San Francisco and New York, but we're seeing emerging strength in some other markets that are pretty unique to UDR in terms of our exposure. That would include Orange County, California, and Philadelphia.
So those are new markets for you?
They're not new markets for us, but they are markets where we have higher exposure relative to the peer group.
Can you talk a little bit about your typical tenant in terms of what changes you've seen, demographic shifts, etc.?
Sure. We touched on demographics in terms of the later age of marriage and children. Also, our tenant really likes the apartment lifestyle. So I spoke about the turnover rate of about 40%. We also track of those who leave who are moving out to buy a home. And that rate is about 5% today, down from a long-term average of 10 to 15%. And then the peak back during the 2004 to 2007 timeframe was above 20%. So there certainly is some desire amongst some of our residents as their households grow in terms of size to move out and buy a home. But generally speaking, that preference for the apartment lifestyle, plus generally the high cost of single-family home ownership, is causing them to stay in place longer.
And are you having to make particular amenity changes to keep your tenants in place?
We're always innovating around amenities and services that we can offer to residents. And that could include things that are very traditional, such as parking, but not just providing it, but optimizing for their needs. And Wi-Fi would be another example of something that we've rolled out across the resident base. So those types of services plus studying amenities, what is being used by the resident, what are they looking forward to, such as a relatively new item would be package lockers, of course. That's critical in this day and age.
And given all these conditions, what scope is there for rent increases at the moment?
Rent increases at the moment broadly across our 20 markets are at an inflation type level. So you see stronger renewal increases than those on new move-ins. So if you move out and I move in, that's more so of a flattish increase at this time, whereas a renewing tenant might see an increase in the 4 to 5% range. And then there's a variety of increases across markets, with the greatest strength being in San Francisco and New York, where you're in the mid to high single digits.
Looking a bit more at the resident side of the business, can you talk about the affordability issues and how that's impacting turnover?
Sure. In terms of affordability of single-family homes, by our measure, the proposition in favor of apartments relative to single-family home ownership is at the lowest level of this century, meaning that apartments are more attractive than they have ever been relative to home ownership over the past 25 years or so. That is due to the fact that interest rates have increased, home prices remain high.
And can you talk about how you're looking at capital allocation today in order to keep the balance sheet the most flexible as possible?
Our balance sheet is in great shape. We focus on liquidity, making sure that we are positioned for every part of the cycle. And as it relates to capital allocation, we provide a heat map that illustrates the risk-adjusted returns for both sources and uses of capital as we see them. It's important to us to be transparent to our investors in terms of what we think will deliver the best returns for them. And at this time, the top source of capital is dispositions. The top use of capital is share buybacks. That's because the apartment REITs happen to be trading at a discount to the underlying value of their assets. It's rare and fleeting, this opportunity to sell assets for 100 cents on the dollar on Main Street and buy back the stock for 80 cents on the dollar on Wall Street. So we're able to generate accretion from an earnings perspective, both over the near term through that trade, but also over the long term as we enhance the long-term growth prospects of the business. As we select dispositions, we're looking for assets that our proprietary data analytics tool called Orion views as having less rent growth potential. And then when we do make acquisitions, which is not that often, we look for at the asset level, much more so than at the market level, to find assets that will generate outsized rent growth.
And what's competition like for those assets?
It's healthy, as we have executed on several $100 million of dispositions this year. We've been fortunate to work with a pretty robust transaction market, and buyers are looking forward to what they view as potential improvement in rent growth in 2027 due to the continued decline in multifamily supply.
And Dave, you touched on this already, but can you talk a little bit more about data-driven analytics, how important that is to UDR today?
Sure. It fits within our culture of innovation, and it's a very data-driven process at the asset level. So traditionally, UDR and others might have allocated capital across the nation based on their views of markets over the long term. What we're doing is that we are fortunate to start with about 20 markets that we're in. Then we're looking across those markets for the assets that we view as being mispriced, meaning that our view of rent growth potential is different than consensus. So that's where we go hunting with Orion to find those opportunities. And then we work in the perspective of our operational team, which can immediately add value through generating revenue and controlling expenses. And we're mindful of CapEx as well. So it's a data-driven approach that's allowing us to recycle capital and enhance growth prospects for UDR.
And Dave, looking ahead, where do you see the biggest opportunities and potential challenges ahead?
Well, the operating environment has been choppy over the last couple of years, in part due to political changes that have been made, ranging from Liberation Day to the government shutdown to a war currently. So that requires that we remain very agile from an operating perspective, and we expect to retain that focus.
Excellent. Dave, thanks so much for coming in.
Thank you for having us.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.